ever considered how financial choices today shape your future wealth? As we embark on this journey together, it's important to remember that the world of investing is a vast ocean, teeming with opportunities. However, navigating these waters requires knowledge, foresight, and a keen sense of direction. In the following minutes, we'll be exploring 20 different types of investments, each with its unique characteristics, benefits, and risks. From the safety net of an emergency fund to the high-tech world of robo-advisors, from the steady appeal of dividend stocks to the shiny allure of commodities. Whether you're looking to build retirement wealth, generate passive income, or fuel your entrepreneurial dreams, there's an investment type that suits your financial goals and risk tolerance. Remember, the earlier you start investing, the more time your money has to grow. So, are you ready to dive into these 20 investment choices? Buckle up, it's going to be an enlightening ride. First things first, security. Have you thought about an emergency fund or retirement accounts? Let's start with the emergency fund. Picture this. You're cruising along life's highway when, out of the blue, a financial pothole appears. Perhaps it's an unexpected medical bill, a sudden job loss, or a major car repair. These are the rainy days that an emergency fund is meant to cover. It's not just about cushioning the blow, it's about giving you peace of mind. So how do you build this safety net? Start by setting aside money in a high-yield savings account. The aim is to cover about 3 to 6 months of living expenses. This may seem like a tall order, but even a small amount saved regularly can add up over time. Remember, it's not about reaching the goal overnight, it's about taking steps in the right direction. Now, let's move on to retirement accounts, specifically the 401k and the individual retirement account, or IRA. A 401k is a retirement savings plan sponsored by your employer. It allows you to save and invest a piece of your paycheck before taxes are taken out. The best part? Many employers match a portion of your contributions. It's like free money. On the other hand, an IRA is an account you open on your own. It offers tax breaks which can help you save more for retirement. There are two types, traditional and Roth. The main difference lies in the tax treatment of your contributions and withdrawals. In a nutshell, these retirement accounts are powerful tools in your investment toolkit. They not only help you save for a comfortable retirement, but also provide tax advantages. Remember, the earlier you start, the more you accumulate. So, whether it's building an emergency fund or contributing to a retirement account, the key is to start now. Even small amounts can grow into significant savings over time. After all, the journey of 1,000 miles begins with a single step. And in this case, that step could lead you to a secure and comfortable future. Ready to step into the world of stocks? Well, buckle up. The ride might be a bit bumpy, but the view from the top is absolutely worth it. Let's begin our journey by understanding the three main types of stock investments: individual stocks, index funds, and dividend stocks. Imagine a bustling marketplace. That's the stock market for you. Here, individual stocks represent a share in the ownership of a company. When you buy a stock, you're essentially buying a piece of the company. This means you get to share in their successes, but also their losses. It's a bit like a roller coaster ride, thrilling, but also risky. However, with the potential for high returns, individual stocks can be a compelling choice for those with a strong stomach for risk. Now, if you're someone who prefers a merry-go-round over a roller coaster, index funds might be your cup of tea. An index fund is a type of mutual fund or exchange-traded fund that aims to replicate the performance of a specific financial market index. It's like betting on the entire market instead of a single player. This approach offers diversification, spreading the risk over a wide range of stocks and thus is typically less volatile than individual stocks. Finally, let's talk about dividend stocks. Picture a generous tree that regularly drops fruit into your basket. That's essentially what a dividend stock does. Companies with dividend stocks distribute a portion of their earnings back to shareholders on a regular basis. This provides a steady income stream, which can be particularly appealing if you're looking for more stability in your investment portfolio. Remember, investing in the stock market is not a guaranteed path to riches. It's a journey filled with ups and downs, twists and turns. However, with careful planning, a good understanding of the market, and a diversified approach, it can certainly be a rewarding one. Stocks might be risky, but they can also be rewarding. So, are you ready to take the leap? Ever dreamt of owning property? Imagine having a steady stream of income trickling into your pocket month after month. That's the power of real estate. Investing in property can yield two types of returns: rental income and capital appreciation. With rental income, you're essentially becoming a landlord. You purchase a property, find tenants, and collect rent. This can provide a consistent, stable form of income that's often higher than what you'd receive from other types of investments. On the other hand, capital appreciation is a bit like playing the long game. You're banking on the property you've bought to increase in value over time. When you're ready to sell, you pocket the difference. That's capital appreciation. But remember, while real estate can be a great way to build wealth, it's not without its challenges. It requires a significant upfront investment, ongoing management, and the risk of property values decreasing. Now, if the idea of becoming a landlord or dealing with property maintenance doesn't appeal to you, don't fret. There's another way to reap the rewards of real estate without the hassle. Enter real estate investment trusts, or REITs. REITs are companies that own or finance income-producing real estate. They work much like a mutual fund, allowing you to invest in a diversified portfolio of properties. The beauty of REITs is that they trade on the stock market, meaning you can buy and sell shares, just like you would with traditional stocks. This gives you the flexibility to invest in real estate, even if you don't have a lot of capital to start with. Plus, because REITs are required by law to distribute at least 90% of their taxable income to shareholders, they can offer a steady income stream in the form of dividends. To sum up, real estate can be a lucrative venture, offering the potential for both steady income and long-term growth. Whether you choose to invest in physical property or opt for REITs, the key is to do your research, understand your risk tolerance, and make informed decisions. Remember, property isn't just a place to live, it's a potential goldmine, ready to embrace the digital age of investing. Let's unpack the intriguing world of modern investment practices where technology meets finance. We'll delve into peer-to-peer lending, robo-advisors, and the enigmatic realm of cryptocurrency. First, let's talk about peer-to-peer lending. In essence, it's the Airbnb of investment. It's a system where you can lend your money directly to individuals or businesses in need of a loan. This is all facilitated through platforms that match lenders with borrowers. The beauty of peer-to-peer lending is that it cuts out the middleman, the banks, and potentially offers you, the lender, higher returns. However, it's not without risk. Unlike a bank, if the borrower defaults, you may not get your money back. So it's essential to diversify your investments across multiple loans. Next, we have robo-advisors. These are automated investment platforms that manage your portfolio based on your risk tolerance and financial goals. Think of it as your personal Wall Street trader, but it's a computer algorithm. The advantage here is the convenience and affordability. Robo-advisors often have lower fees than traditional financial advisors, but remember, while they're programmed by experts, they're not infallible. They follow preset rules and can't react to market changes with human intuition. Finally, we venture into the world of cryptocurrency. This digital currency, like Bitcoin or Ethereum, has made headlines for its extreme volatility. It's a high-risk, high-reward investment. Some people have made fortunes, while others have lost large sums. Cryptocurrency operates on a technology called blockchain, which is a decentralized system spread across many computers that manage and record transactions. The allure of cryptocurrency is the potential for significant returns and its use as a hedge against traditional financial market instability. However, it's worth noting that cryptocurrency's regulatory, technological, and security risks make it a very speculative investment. The digital world is full of investment opportunities, but tread carefully. As with all investments, it's crucial to do your research, understand your risk tolerance, and invest wisely. The digital age of investing is here, offering both exciting opportunities and new challenges. What about traditional investment routes, you might ask? Well, let's dive into the world of bonds, certificates of deposit, also known as CDs, and the value of investing in education. When it comes to stability, few investment avenues can match the consistency of bonds. Whether they're government or corporate, bonds are essentially IOUs. When you buy a bond, you're lending money to the issuer for a set period. In return, they promise to pay you interest at regular intervals and to return the principal amount on a set maturity date. It's like a structured, long-term IOU where you're the lender and the issuer is the borrower. Now, the returns might not be as high as more volatile investments like stocks, but they're generally more stable and predictable. Next up, we have certificates of deposit, or CDs. These are time deposits offered by banks with a fixed maturity date and interest rate. Think of them as a lockbox for your money. You put in a certain amount, the bank locks it away for a set period, and in return, you get a guaranteed interest payout at the end. CDs are low risk, and while the returns might not be sky high, they're reliable. And finally, let's not forget about the value of investing in education. Whether it's formal education, online courses, or skill development, investing in your own knowledge and abilities is one of the most beneficial investments you can make. The returns might not be immediate, but increasing your skill set and knowledge base can significantly boost your earning potential over time. Plus, it's an investment that no market downturn can take away from you. So there you have it. Bonds and CDs offer stability and reliability, while investing in education provides long-term benefits that can significantly increase your earning potential. Each of these traditional investment routes has its own unique benefits and can play a crucial role in a diversified investment portfolio. Sometimes, the old ways are the best ways. Ever thought about taking the investment road less traveled? Indeed, while the mainstream financial markets offer plenty of opportunities, there's a world of unique investment options that could also unlock significant wealth. Let's start with commodities. These are physical goods like gold, silver, or oil. Investing in commodities can diversify your portfolio and serve as a hedge against inflation. This is because commodities often increase in value when the cost of living rises. So if you're concerned about inflation eroding your wealth, commodities might be a good choice. Next, we have crowdfunding. This is a way to invest in startups or small businesses looking for capital. By pooling your money with other investors, you can help these companies get off the ground and potentially share in their success. It's a bit like being a mini venture capitalist. Just remember that investing in early-stage companies can be risky, so it's not for the faint-hearted. Then we have collectibles and art. These are physical assets that can appreciate in value over time. Think classic cars, vintage watches, rare coins, or paintings. While these investments can be risky and require expertise, they can also diversify your portfolio and potentially offer high returns. Plus, they're a lot more fun to show off than a stock certificate. Switching gears, let's look at some safer alternatives. First up, we have Treasury inflation-protected securities, or TIPS for short. These are government bonds that are adjusted for inflation. This means the value of your investment increases with inflation, protecting your purchasing power. They're a safe and steady choice, especially for conservative investors. Next, we have 529 plans. These are tax-advantaged savings plans designed to encourage saving for future education costs. Whether you're saving for your child's college tuition or your own lifelong learning, a 529 plan can help your money grow tax-free. Plus, you might be able to deduct your contributions on your state tax return, depending on where you live. Finally, we have life insurance. Now, you might be thinking, isn't that just for when I die? Well, yes and no. While a life insurance policy does provide a payout to your dependents when you pass away, certain types of policies also have an investment component. This means a portion of your premiums can grow over time, providing you with a cash value that you can borrow against or even withdraw. So, investing in a life insurance policy can provide both financial security and potential growth. Diversification is key to a balanced portfolio. By exploring the road less traveled, you can discover unique investment opportunities that align with your financial goals, risk tolerance, and personal interests. So, why not take a detour from the beaten path and see where it leads you? So, feeling more confident about investment choices? Let's quickly recap the essentials. From setting up an emergency fund in a high-yield savings account to investing in retirement accounts like 401k and IRA, we've covered the basics. We've also delved into investing in the stock market, ETFs, and low-cost index funds, and the appealing stability of dividend stocks. We've explored real estate, REITs, peer-to-peer lending, and the innovative world of robo-advisors and cryptocurrency. Bonds, CDs, and the importance of investing in your own education were also discussed. We touched upon commodities, crowdfunding, collectibles, tips, 529 plans, and the security of life insurance. Remember, the key to a robust financial future is starting early and diversifying your investments. Remember, your financial future starts today. So, what investment will you make? Comment below, like this video, subscribe to our channel and share this with someone who needs to see it. Happy investing!